Hi everyone, welcome to another Port Jackson Securities webinar. I am your webinar host, Caitlin Chung, and today we are fortunate enough to be joined by CEO Lawrence Lun of eCargo. Thank you so much for joining us today, Lawrence.
Thank you.
Today, Lawrence will give us a brief overview of eCargo and what they do, and then we'll go through a Q&A. So feel free to pop your questions into the chat anytime and we'll go through them. But I'll hand it off to you first, Lawrence.
Thank you, Caitlin. It's always a pleasure. So I guess I'll start off with an introduction on eCargo. Our business was founded in 2014, and we are a brand accelerator. So what we aim to do is help brands build their business in Asia, primarily in China. And what I mean by build their business is basically help them with the whole one-stop end-to-end. So from supply chain management, from logistics, all the way to distribution, all the way to marketing, content generation, and selling the product basically to the end consumer hands in Asia, especially Chinese consumers. Our business services it across multiple categories. We support health and wellness products and brands. We help food and beverage, specifically in the premium side, baby and mom products, as well as personal care. Our services basically span from just helping a brand operate their online stores all the way to helping them also get into offline brick and mortar stores as well in parts of Asia.
So in short, you help existing businesses that want to enter the Asian market? Correct.
We help brands sell more in Asia.
Great. Okay, well, let's get into the question. Thank you for that introduction. First question is, China is a big part of your business model. Can you talk through how the business has been impacted by lockdowns in China and the associated supply chain issues?
Yeah, so we chose China as our primary market, partially because back in a few years ago, so in 2014, when we decided our business model, China was fast growing, income was increasing, demand for overseas products was growing, as well as the policies regarding importation or cross-border trading were becoming more favorable for brands and businesses that wanted to sell into China, as well as because of China's different culture, language, and customer behavior. A lot of brands really needed partners to actually help them enter into the market. Now, fast forward, we had COVID, and surprisingly, while the rest of the world is currently opening, China is still going for its COVID zero policy. So for the first half of this year, we've actually had a few months of lockdown in some of the main cities, including Shanghai. So that's still currently persisting, right? In first and second tier cities. There's occasionally some lockdowns, some restrictions, which have limited some of our distribution channels, right? And also affected some of our different brands, not just our brands, but different brands that are also trading in China. Now, in terms of the whole supply chain side, I would say that it's not as bad as 2 years ago, when really the supply chain there's a lot of disruption regarding products from China going overseas, whether that's a shortage of freight, shortage of sea freight boats, a shortage of containers. Where we're today is because of after 2 years, 2.5 years, better policies, better movement of products, as well as there's less dependency on main ports. There's a lot more different ports that people utilize. The supply chain situation has alleviated and has become better. So you do see a decline in shipping rates compared to 2 years ago, where there was an enormous increase in terms of shipping product out of China into other parts of the world. For us as a business going into China for products, while online is continuing to grow, and that's where a lot of consumer behavior in terms of shopping behavior has now moved to online. Our offline distribution business, where we're more focused around tier 3 to 4 city and more rural areas, has continued to grow as well, despite the whole COVID situation.
And the clients that you work with, are they purely e-commerce businesses, or do they actually have stores in Asia?
Yeah, so our business shift has changed over the years, right? In the beginning, we only service brands purely on their online business. whether that's trading on Tmall or Jingdong or VIP, these large marketplaces. But since 3 years ago, when we acquired the cash export business, and then also a number of other smaller businesses, we built up this capability of servicing brands, not just purely online, but we also support their entry into brick and mortar stores, where we actually have distribution relationships with supermarkets, department stores, convenience shops in China. Currently in our portfolio, we have over 4,000 point of sale locations offline in both second, third, and fourth tier cities that we can actually support our brand partners to get their products in, as long as trading within those categories that I initially talked about. So currently our brand partners is we don't just service them online, but we service them both online and offline distribution in China. Now, in the last 18 months or so, we have been expanding our business models and replicating that across different parts in Asia. So we have now expanded into Southeast Asia. So we do service our brand principals also in Vietnam and Cambodia in the same similar model that we service for China.
And I'm sure there's a big shift in terms of learning about new cultures. Is that something that you help the business, when they're entering a new market? There's so much to learn about how to adapt with different consumer market, different language and everything. Do you guys provide services where you kind of offer cross-cultural training?
Yeah, so I think we don't actually specifically have a service saying, oh, we're going to help you with training you in the local culture. It's through basically experience and through working with us as a partner that our brand principals and are also our partners that would generally get to learn right about the local markets and how to actually operate in it. In terms of the market wise, yes, there is a local culture, local language perspective. But one of the reasons that a lot of brand partners choose to work with eCargo is because one, they don't have the experience to do export into those countries. Working with us as a partner that has been doing it for many years helps speed up that process, accelerate that process, so that they don't have to hit the same obstacles that every brand will probably have would hit if they were to go themselves. Second is because of our status as a listed company, we also offer a lot of transparency in our governance and also our compliance policies. So a lot of times when we talk to brand partners that have worked with other partners in those markets, they've always say you generally are trading in a black box, but working with eCargo, we'll be able to give that transparency. Right, we pride ourselves in terms of communication to ensure that the brands that are operating have clear strategy, clear plans when they're trading in those markets that they're new to.
And you recently sold the digital commerce consultancy part of your business. What was the reason for this divesting?
Yeah, so we acquired Amblique's business shortly after we listed in Australia back in 2015. And Amblique's business is a great business. It's a digital consultancy business that has supported a lot of local Australian brands, including Michael Hill, Emu, Lorna Jane, these brands in terms of setting up their e-commerce platforms for trading in Australia. Now, that business has always been in our portfolio and has always operated as a separate business within our group. Now, what happened was we saw an opportunity to divest the business late last year when we reviewed our strategy for eCargo. We looked at really where are the areas of opportunity, where are the areas that we want to focus on in the next 12 to 18 or in the longer term for eCargo's business, and that is to focus back what our core strength is really to help brands export, get into new markets that they've not traded in before. So we want to focus on building those capabilities, ensuring that we have a full ecosystem. So when we had an opportunity to divest and realize the value in Amblique's business, we decided to take that. And we sold Amblique's business recently in order to recover some proceeds that we can then reinvest into eCargo's capabilities, eCargo's value propositions, our proprietary platforms that we've been pushing to make cross-border trade easier, as well as starting to move upstream in our strategy, which is because of the many years of experience of helping brands get into new markets, we know what are the ways to do it. We also want to be able to be part of that brand, right? Invest into the brand that we're helping, or perhaps owning the brand that we want to take into Asia. That way we generate value on both sides for our shareholders, not just on revenue for sales that we make, as well as on the brand equity side. As we build up the brand, they also generate higher valuation that's also be able to capture within the business. So that's kind of where our strategy is with the proceeds from the divestment.
So speaking of revenue, the revenue streams, do you charge, say, like a once-off project fee with these clients, or is it like an ongoing monthly fee?
Yeah, so our business revenue comes from two main sources, right? One is purely a service model where we charge a monthly retainer, as well as a sales commission for sales that we generate on behalf of the brands that we're operating with. So basically, they will outsource their entire operations to us, and we're their operating partner in China or other parts of Asia. Now, the second model is something that we've dived into over the last 2 years since we acquired the Metcash business, is that we also want to become an exclusive brand partner. So once we identify a brand that we think has a lot of value, has a lot of potential in a market, we will sign on exclusivity with the brand so that we can actually go on the journey to help build the brand together in the space. That is more on a trading or more of a margin basis where we actually have a wholesale distribution price, and then we have a selling price where we either sell to distributors, and that's where our revenue would then get captured, rather compared to a monthly retainer basis.
So it's more of a longer term relationship with the clients.
Correct. So you would look at those relationships as being 5 years or more, while we're looking in terms of a service relationship, it would more probably about 2 to 3 years is a typical contract period.
And in going back to the digital commerce consultancy part, it's a sale of US $5 million. How do you plan to invest these proceeds?
Yeah, so over the last 18 months, eCargo has been a renewed focus on really 3 areas, right? One is our own proprietary technology, which is basically when we first started the business, it wasn't just purely a service model. So it also had the technology element to it, where we actually put a lot of R&D investment into developing our own backbone infrastructure, which we call eCore OS at that point. Basically, it manages all the digital footprints of a brand that's trading in China, whether that is managing the orders or managing the fulfillment. So over the last 18 months, we've basically renewed that focus to focus on technology. So we've pushed a number of different platforms into market. One is called JJX, which is really a pinyin, a Chinese translation short term, so it's called JJX, and basically is for B2B trading, right? For any supplier that is currently in Australia or in other parts of the world that want to get into our distribution network, they can go onto our platform, register the product, and therefore our distribution network in China can already be able to buy the product, and we handle everything in between. So that's a B2B trading platform. Another one is more B2C, so direct to consumer. Again, focus on Chinese consumer, but we decided to choose a category which is fine wine. And because of the logistic complexity for importation, as well as some favorable rules around cross-border trade, we decided to develop our own B2C marketplace to facilitate that, which is called PJF Wines. So those are 2 proprietary platforms that we'll continue to develop. However, within our whole ecosystem, because we are ultimately, besides a brand accelerator, if you purely look at it, we're a supply chain management company, right? We manage the whole supply chain from product origin all the way to consumer. So we will also invest into different technologies that will build up that ecosystem. Now, in the coming 6 to 12 months, we'll be launching a new platform relating in the marketing capability aspect to help brands really drive higher visibility a lot quicker than the typical marketing strategy. So that's one area where we would put the 5 million proceeds into. Second is actually, I mentioned before, we were investing into brands, right? That we have potentials, that we see potential, so that we can have a 2-pronged strategy, both sales and both building up the brand perspective, because we are a brand builder, right? We're not a trader in this market. So therefore, we put that proceeds into that aspect. And then the third is to build the team. Talent is a key, right, into doing this. It's not just finding channels to sell a product. We actually have to have right people in the team to actually help work with the brands to develop their portfolio, develop their story, develop their awareness in the new markets that they're trading in. So that's where we'll also invest in those proceeds in those areas.
So you must have a really global team. Do you have many offices across Asia?
Yeah, so eCargo's business within eCargo, our head office is in Hong Kong, right? But we have offices in Sydney, Melbourne, Shanghai, Shenzhen, and London. So those are really our key operating areas. But within eCargo, we also have our parent company, which is owned by our chairman, John Lau, which is called Cargo Services. That's why we have the logistic capability, because it is a traditional logistic company, is our parent company. And with that parent company, we have over 80 different offices around the world that allows over 10,000 staff that really provides that foundational support that we need to move product from A to B. So that gives us one of the key advantages that a lot of other partners or other peers that might not have when they're working with us.
Yeah, I'm sure the synergy between cargo services and eCargo would be really good. It's like the logistics and everything together, right?
Yeah, exactly. Sorry.
Yeah.
Go ahead.
Sorry. Can you give an overview of your recently announced interim results, please?
Yeah, absolutely. So, you know, when I came back about 2.5 years ago, we were on a journey to ensure that we drive profitability in a business so that we can generate value for our shareholders. So I'm pleased to say that on the first half of this year, on our recent interim results, we did generate a net profit for the first 6 months of about 24.7 million Hong Kong dollars. Now there's obviously a one-off gain from the sale of Amblique, which is about 23 million. But if we look at just continuing operations, we did generate about 1.4 million Hong Kong dollars in terms of net profit, which translates to be about 350,000 Australian in terms. Now, why is this significant? Is because there's a few things that happened in the first 6 months of this year, right, that we didn't plan for. The major one that really impacted our revenue, which did decline by 7%, was the China lockdown. Right, we had a lockdown period of 3 months, which disrupted some of the sales that we originally had planned. However, despite that, our gross profit did increase, right, to 39%, so about 16% increase compared to the year before, which is the first 6 months of last year. So we're, in terms of our business, we're performing healthier, right? We're generating better margins, with better cost management, and we're also better scalability across our whole entire business. And this is the first, right, for the business, because last year, for 2021, for the fiscal year, we generated our first profit, which is, while very small, about 900,000 Hong Kong. This year, first 6 months, we already generated and beat that already in terms of our continuing operations. So we're in the right trajectory to continue generating value for our shareholders.
Mm-hmm. And one last question from me. What should investors be looking out for in the next 6 to 12 months for eCargo?
Yeah, so without saying too much, I think we will continue in terms of our trend. We have a number of new brands that we've signed on over the last couple of months that we are now already developing their business in parts of Asia. So we will see contribution coming into the business for those new brands. Second is, I mentioned new technology platforms. We will be launching new platforms around in the marketing space that will be launching within this year. In the last quarter, so that's something the shareholders can also expect, as well as you know, a continued path in the trajectory to generate profitability for the business is also something that we'll continue to always strive for within the team.
There seems to be a lot to look forward to, especially with Asia opening back up slowly, but still opening back up. So there's so much business opportunity there. But it was really, really great to have you on, Lawrence. Thank you so much. For those that are watching the recording, you're welcome to send me an email with any questions and I can pass them on to Lawrence. But thank you so much, Lawrence, for joining me today.
Thank you, Caitlin, and thank you everyone for listening.
Thank you.
Thank you.